Many people in 2026 follow traditional rules of saving, living below their means, yet feel like they are rapidly falling behind. This chart explains that sensation. Headline inflation hit 4.2% in early 2026, driven by Middle East energy shocks. This creates cash drag. When your money sits uninvested while inflation stays high, your purchasing power follows this diverging downward curve. It is easy to focus on global events that are impossible for an individual to influence. However, the specific variables of a portfolio, like account types and tax classifications, remain entirely adjustable. Navigating the 2026 economy is less about predicting global supply chains and more about modifying the specific financial mechanisms you actually control. The first defensive adjustment for 2026 involves capturing the updated IRS Contribution Limits. The ceiling for 401ks has increased to $24,500, while IRAs rose to $7,500. This bar chart shows the long-term impact of those small increases. A 28-year-old who raises their contribution rate by just 1% creates a massive shift in their total balance 30 years from now. High earners making over $150,000 need to be aware of a new Secure 2.0 requirement. For this group, all catch-up contributions must now be made into after-tax Roth accounts. Because not all employers have updated their plans to support this, there is a risk of losing catch-up eligibility entirely. Reviewing your HR portal immediately ensures your account is compliant with these new rules. Ignoring these administrative updates essentially leaves significant compound growth on the table over the course of a career. There is a common belief that the best way to grow wealth is to find a professional who can handpick the right stocks. But for the vast majority of fund managers, the data suggests otherwise. The 2025 SPY scorecard revealed that 79% of all active large-cap funds in the US failed to outperform the S&P 500. While individual stock pickers struggle to keep up, a passive strategy of buying the whole market through an index fund provides a more consistent baseline. From there, the key is minimizing fees. This scale compares two identical index ETFs. VOO and IVV charge just 0.03%. SPY charges 0.0945%. Over 30 years, a $50,000 balance in SPY results in an $11,000 gap in lost returns. Long-term wealth is built less by finding a winning stock and more by systematically removing the friction of management fees. The One Big Beautiful Bill Act also introduced a new tax-advantaged vehicle for children, the Trump account. It allows for an annual contribution of $5,000 per child. Crucially, and unlike a traditional IRA, the child does not need to have a job or any earned income to accept this money. Employers can also contribute up to $2,500 tax-free directly into the child's account as an employee benefit. The legislation includes a unique constraint. These funds are locked into low-cost U.S. equity index funds until the beneficiary turns 18. This structure ensures that the money remains invested in the broad market for nearly 2 decades, allowing generational compounding to occur without early withdrawals. In 2026, there are 2 distinct paths. You can react with panic to daily inflation news, or be the person who quietly optimizes their structure. The strategy involves 3 specific updates: capturing the higher 401k limit, switching to the lowest cost ETF, and opening a dedicated child's account. Geopolitical crises are outside of your control. However, your fees, your taxes, and your savings rate are not. Making one of these adjustments today changes the mathematical trajectory of your portfolio over the next several decades.